you can see that they've got $135.8 billion in total cash and short-term investments. So Google might just have one of the best balance sheets in the world. G'day guys, welcome back to the Devon Too Good Investing channel. If you're new to my channel, I like to do stock valuation videos where I'm looking to implement a 10-step analysis checklist which will help us evaluate and give us a bit of a look into whether a company might be worth investing into. And if it is worth investing into, then we can take our 10-step checklist and we can use the information from that to give the company a deeper look later. Now, this 10-step analysis checklist is an adoption of fellow YouTuber and value investor Andrew Brown. He runs a channel and he also does stock valuation videos. So in this video today, we're going to be looking into Google stock. And Google stock, to put it short, they're a bit of a beast. They've got a $1.82 trillion market cap, and their business model is mainly online advertising, where they have a 29% global market share. Google's main business of online advertising makes up over 80% of Google's revenue. And they've also got a cloud segment of their business that is growing very rapidly, where they have grown 46% year over year for their full year results. And if we look at the 5-year chart for Google, you can see that they're actually up 250% in the last 5 years. And you can see that since sort of the pandemic crash, the stock has pretty much rocketed up and delivered very good returns. So step one of the checklist is to categorize the stock according to Peter Lynch's 6 categories. So you've got either a slow grower, which is a slow growing company. You've got stalwarts, and they usually grow at between 8 to 12%. We've got fast growers, and they usually grow 15% or higher. We've got cyclicals, we've got turnarounds, and we've got asset plays. Now, the purpose of putting the stocks that we analyze into one of these 6 categories is it gives us an idea on how we should value the company and how we should really think about the company. For example, if it's a fast grower, we're going to put bigger emphasis on revenue and revenue growth. Whereas if it's a slower grower, we might put bigger emphasis on free cash flow and probably shares outstanding, as we'll probably be expecting some sort of buybacks from slow growers. Or potentially asset plays, well, we're probably going to have a bigger emphasis on something like debt. But anyway, these categories here will help us value the business at the end by applying a more appropriate multiple. For me, Google is definitely in the fast grower category. Fast grower categories, they're generally growing quite aggressively, and you can expect them to be growing at 15 to 25% per year. They usually grow fast compared to other competitors in the industry. And Peter Lynch with fast growers advises that you've got to keep an eye out for whether their growth is sustainable and the likely downside if this growth does stop. So yeah, Google is definitely categorized as a fast grower. So the next step is to have a look at revenue growth. So revenue is the amount of money generated by the sales of goods or services, and we really want to see this growing over time. And in the case of Google, because they are a fast grower, we definitely want to see that their revenue growing at least 10%, but probably preferably 15% or faster. So let's go have a look. So this graph here shows Google's revenue for the last 5 years, and you can see that over time it has grown quite significantly, and it's grown very consistently as well. You can see in 2016 they had about $90 billion of revenue, and then in 2020 they had about $182 billion in revenue. So that's about a double. So that represents roughly 15% 15% CAGR over the last 5 years. And if we show the change in revenue growth year over year, you can see that their revenue growth is starting to slow down, where it only grew 12% last year. However, this will be something to look out for, but I do believe that Google is a solid business and that they will continue to deliver double-digit revenue growth, at least for the next few years. So I feel like Google deserves a tick for revenue. The third step is to check gross margins. So gross margins is the revenue minus the cost of goods sold divided by the revenue. then multiply by 100 to bring that number into a percentage. So we're going to be looking for growing gross margins, as this indicates some sort of competitive advantage. If these gross margins are decreasing, it can usually mean that the industry that Google are competing in, there's a lot of competition, let's say. So let's go have a look. So we can see on this graph here that back in 2016, Google had gross margins of 61%. And then in 2020, they had gross margins of 53%. And you can see over the last 5 years, this has declined, which does indicate that the competition for Google is increasing. However, we should really point out that gross margins of 60% and even 53% is insanely high. So just because of that, I do believe that Google does deserve a tick for gross margins, as these are still great gross margins. Now, the fourth step is to look at free cash flow growth. Now, free cash flow is one of my favorite metrics when I evaluate or look into any stock. So free cash flow indicates the amount of cash generated each year that can be used for reinvestment back into the business, share buybacks, or dividends to shareholders. So free cash flow is found by taking the operating cash and minusing out the capital expenditure. So let's go have a look at Google's free cash flow growth. So this highlighted line here does show the free cash flow for Google over the last 10 years. And you can see that for the most part, it has been consistently growing and getting bigger each year. You can see that there was a bit of a slowdown back in sort of the first 5 years of the 10 years. And there's also a bit of slowdown a couple of years ago here. So it might be worth looking into why this happened. My guess would be higher capital expenditures. However, overall, they've grown it, they've 4x their free cash flow in the last 10 years. So that is a 15% free cash flow growth per year. And if we jump over here, you can see that over the last 5 years, their capital expenditure has been growing, but recently it has started to slow down and taper back down, which has led to more expansion in the free cash flow growth. And that's why you can see this growth accelerating here. But I think Google does deserve a tick for free cash flow growth. The fifth step is to look at return on invested capital. So ROIC tells us how effective the management are at investing back into their own business. And for this, we want at least 10% per year. However, we do want to see this number consistent and preferably 15% or higher per year. If we jump back to Ticker, we can see Google's return on invested capital over the last 5 years. And you can see that it's consistently been above 15%. And it's been as high as 18% and pretty much as low as 16%. So this gets a big tick for us, and this shows that the management are effectively reinvesting back into their own business. Step 6 is to look into debt management, and for this we want a current ratio above 1. And we also want debt to be payable within less than 3 years worth of free cash flow. So let's go and see if Google meets this criteria. So looking now at Google's current ratio, you can see that it's currently at a 3.07. So this is 3 times my minimum requirement. And if we have a look at the balance sheet, it's actually a super beautiful balance sheet. You can see that they've got $135.8 billion in total cash and short-term investments. So Google might just have one of the best balance sheets in the world. It's a spectacular balance sheet, and debt is certainly no problem for Google. So step 7 is to look at insider ownership. So what we want is a management team who own significant amounts of their own stock. Ideally, we would want the CEO to be the founder of the company. And also we'd want to see that they have reasonable salaries or stock compensation. So let's have a look. So of the shares outstanding, insiders own 2.93% of the company. So we've got to factor in how large the company is. Usually this would be quite low, but because Google is a $1.8 trillion company, this is, it's a decent amount. So if we go down we can see that of these direct holders, Larry Page and Sergey Brin, they're the two largest ones. They were the founders of the company. And we can see here that the current CEO does hold some shares. He holds 46,000 shares. So if we multiply out 46,000 by 1,000, we get a really big number. So for me, look, this isn't a deal breaker for me. I think it's okay. I'm going to give him a tick. So step 8 here is to look at shares outstanding. So shares outstanding is the amount of pieces the company is split up into. So what we want to see is the share count decreasing over time, as this indicates that share buybacks have been happening and that our overall ownership of the company is increasing with time. We can see here on this graph that Google's share count has remained pretty consistent over the last 5 years, though we do know that they're starting to do some share buybacks, and you can see that the share count is starting to decrease a little bit for Google. So you can see the exact share count here, and it is starting to decrease. So this is a good sign for Google. I do believe that the company will begin to buy back lots of shares with their free cash flow. So this gets a tick for me. Now the ninth step is to look at super investors. So we want to see how many super investors own Google stock. So the reason why we follow these guys is they've got proven track records and they've been long time value investors. So if they own the stock, it could mean it's a good investment. So let's go see who owns the stock. So over on Dataroma, Google is a very popular super investor stock. You can see that there's quite a few high conviction positions by pretty well-renowned value investors. You can see Chris Hahn, John Armitage, Lee Lu's a big one. David Tepper's another big one. Seth Klarman's another big one. Just the list goes on and on. It's a very popular stock among these very popular value investors. So for me, the super investor section gets a tick. Now the last step of the analysis is to look into the valuation. So no business is worth an unlimited amount, and paying too much for an investment can lead to a bad investment. So we need to work out what the business is worth, and then we need to pay less than that amount. So let's go value Google stock. If we jump here to my margin of safety dashboard, and we go to my discounted cash flow of Google, we'll see that if we enter in the 2020 free cash flow, and we add some growth rates that we could expect Google to grow, and then we add a terminal multiple of 20, which is appropriate for a company such as Google. You could probably even have a 25 if you wanted to be more aggressive. And then I've added a 22% return, so this is my discount rate, and this will factor in a decent margin of safety. And I've also factored in net cash into the valuation due to Google's magnificent balance sheet. And based on these different growth numbers, we get buy prices of between $1,400 and to about $2,000. So anywhere between, well, particularly if you can get it under $1,700, I think Google would be a fantastic buy. But currently, Google is at $2,700. So we would need Google to, we would need Google stock to fall a fair bit. Let me just pull up here. Yeah, we would need it to fall about 37% for it to hit this 22% return. Of course, you could decrease your margin of safety, but every time you decrease your margin of safety, that's a higher risk you're taking on. So I'm going to give Google a cross for valuation, as they are a little bit rich for me at the moment. So here's my final thoughts on Google. So they've got super strong margins, and this indicates a really great moat. They also make up a large percent of the overall online advertising market, and they're the leading player. They have pretty much perfect balance sheet, and they've got some really high super investor interest by some really great super investors. However, for me, they're too expensive right now, and I'd want the share price to fall at least 30%, but if it could fall that to 37%, that would be perfect for me. And I do recognize that this may never happen, but of course there's plenty of other stocks out there to look at. So anyway, guys, thank you for watching my video. If you got to the end, make sure you like and subscribe, and we'll be doing more of these videos coming out soon. Thanks for watching.